Okay. Uh, Good. Okay. So fun little story. We met. It was like a TechCrunch party. I think this is in San Francisco. One day we'll go back to doing parties, but this was way back when the world was a little bit normal. And I remember, I think it was 11 p.m. The party was over, and I was going back. At that time, we were just friends, but now my wife and mother of my two children, we were going to a parking lot, and but sadly realized the parking lot was locked. Right, and so we're like, oh my god. And then this very nice couple walks up behind us, kind of in the same situation. And then this was when like I was not in the Valley. I was kind of on the East Coast, didn't know anybody. It was kind of a green. I was in business school, graduate student, didn't know anything, right? And I think we got to chatting. And I remember, I think I was so so newbie. I was like saying something around, oh, Kevin, you may want to refresh. I can tell the story, but you may want to just refresh one more time. But I remember, just for the sake of the audience, what happened was, I think I literally just read an article about Eventbrite, and this was just when Kevin was starting it, a few days before the party, and then we got to kind of discussing, and again, he doesn't know me. This is totally cold, right? Like just then a minute, and I mentioned I'd done a little research on mobile apps. At this time, mobile apps were a big thing, right? And I remember he was so gracious. He was so think about it. You're meeting some random kid in a parking lot, or that's closed. It could have been totally uncomfortable. And he was so gracious. Hey, here's my number. Here's my information. Just follow up with me, and then we'll connect in a couple of weeks. And then that was kind of the start of a many-year-long friendship. I just remember that's just that's almost like I love that story because didn't know me at all, but just super gracious, super understanding, and it's been kind of a great ride since. But with that, why don't we I think we're a few minutes in. Why don't we get started? Maybe to begin, I know we have a lot of business stuff to cover, but Kevin, maybe you want to share a fun personal story from your childhood. Maybe it's funny, unusual, or interesting. I think a lot of folks. It's always good to share a little bit background to everyone. So,
well, I grew up in the East Bay of the Bay Area, which is unusual, and you usually don't admit to because it's not having to. You haven't been in a position to overcome some great obstacles of escaping some Eastern Bloc country, but. I grew up in the East Bay, and I was suspended my senior year for sending out a letter that there was asbestos in the school and that school would be closed. So that was it. It was to coordinate with senior cut day. And I was called to the Postmaster General because we sent it out in nonprofit email or not nonprofit traditional mail. And warned that it was a federal offense, but fortunately not prosecuted.
That's great. Yeah, and somehow none of this is surprising to me, just because just having known you. But I didn't know. That's just funny. That's a great story. Maybe kind of moving along, maybe some short initial stories of how you started Xoom and then Eventbrite. I remember last time we chatted, you actually took a very analytical approach toward starting, I think, both companies around. Just thinking about what opportunities make sense, what could be, what could actually scale to a large market size. I wonder if you could share some of that perspective, because I think it's actually very analogous, perhaps, to how you angel invest as well. So,
well, I had the good fortune of being kind of watching from the front row the PayPal mafia. I'd gone to school with the Peter Thiel side at Stanford University, so there are two sides to the PayPal mafia. There was the Stanford group, which was Reid Hoffman, Peter Thiel, David Sachs, Keith Rabois, and quite a few others that I'll be remiss to not name. And then on the UIUC, University of Illinois, which birthed Mosaic, the browser, you had Max Levchin, who just enjoyed a wonderful IPO with his business, Affirm, and Luke Nosek and the crew that came from that side of it. And I knew the Stanford side. I had stayed close. Peter was and is one of those extraordinary people. And I had the good fortune of being a seed investor. I had a small company that we had sold and had rolled all that money into PayPal. And watching payments grow at that stage was astounding. And now it's nothing like it's grown into now with what the Collisons have done with Stripe and the fintech revolution. But it was it was a platform. And when you see a platform out there like the iPhone in 2007, to build on top of that. And so Xoom, XOOM, the money remittance business, was built on top of PayPal. We initially started off entirely on PayPal, and Eventbrite was built entirely on PayPal. So we had a transactions, payments, fintech focus around the platform of PayPal and its dominance. It had been seen as something that had really just served eBay, but we saw it as something much more. And Dave Sachs, the head of product at the time at PayPal, opened up an API, and we were the very first developers on that API way back when.
Got it. No, I think that's just an interesting approach where you see kind of a big macro change and realize there's probably a few fundamental use cases that have to be built that will likely be big and kind of exciting, and kind of taking the next step there. So, appreciate you that. And then, I think one story I've actually never asked you, what I'm curious about is like, how did you get started in angel investing? What was the first check? How did it all get kind of started? I imagine it's probably through your network, but it's always good to understand how folks begin this journey. So.
Yeah, angel investing came from, I had the good fortune of kind of a small exit, but very, you would say very foolishly kind of plowed that money back in. I just was fortunate that one of those companies was PayPal. But it was always a way for me to learn. So, I had, and I think, the attribute of the Valley is to have a strong degree of intellectual curiosity, and to learn through investing in other companies was a great way to do that. And so while working on my own companies, I angel invested, and that really sharpened my skill of how to recruit, how to handle crisis, how to build better product, how to hire engineers. All these things were incredibly informative to me. I'd recommend it. A lot of cases, or most cases, entrepreneurs, founders don't have the money to invest or to angel invest, but there's a lot of great programs. There's a lot of great programs out there that are enabling founders to invest. I'm not sure where Signal Fire is with a program like that. If you've staked some founders before.
Yeah, no, I think we have a variety of like advisor relationships. We work with pre-seed funds, but no, I think it's definitely something where we invest at all stages. And so, and obviously part of the reason for the summit is to like build bridges and kind of connections with the emerging angel ecosystem. On that end, and I know some of you who were at the panel before, this question might be a little bit maybe repetitive, but I think you may share a different answer. There's really a difference between like just deal flow and access to good opportunities, right? Like I think if anyone put on their profile, I'm an angel investor, you're going to get kind of opportunities, but it's a question of whether you want to invest in those. Whereas I think you've been at it a long time. There's probably a small set of companies and founders and entrepreneurs you want to invest in. How are some ways you're able to kind of differentiate and kind of get access and find ways to kind of invest in those really great and exciting opportunities?
I think just acting in a natural manner of wanting to help people has been that building a reputation in a positive manner in the Valley is, and when I say the Valley, I say the broader innovation economy. I'm making investments in London and around Europe and New York and so on. So the Valley now really extends around the world. But it's goodwill, and that's where the referrals come and the relationships are built. I'm an angel, and so I can be a GDI, a goddamn independent, as the 3-letter acronym comes into play. So I can always be of help to different individuals, different entrepreneurs out there.
Yeah, no, I think that's a good point, actually. Maybe that goes to another question around how you've worked with VC funds, how you partner with them. I think largely it's collaborative, but oftentimes, sometimes incentives or motivations can be a little bit off. And whereas I think you have an opportunity to make sure things are balanced on the side of the founder. Have you seen like certain instances where you've been able to take the side and keep things a little more cordial or balanced?
Yeah, I'm often I don't lead rounds, and so I just try to keep it fair and help a founder make a decision on what good direction to go. Often, it's hard to distinguish, or the founder hasn't been through that that process before, and so providing just an objective note to who are the great investors who are helpful. What are you looking for? Are you looking just for money, or are you looking for some type of assistance? These sort of these sort of attributes are unique, and there's just for some reason there's just not a lot of individual investors these days. I've noticed they're generally associated with some pool of money.
No, that's a great point. I think when we kind of get together our angels, there's always a question around going, e.g., like pro or not. But there's a lot of value around staying independent. And also in your case, you've been through many kind of fundraising cycles, processes, and so can lend a lot of unique advice there. And then maybe that's good advice for some of the folks on the call are also experienced, how to leverage beyond kind of maybe your core operational skill, kind of having gone through it a few times and letting know how certain investors or GPs play, or what their stance is, what their habits are, that sort of thing. So, right. One question, and then we'll jump into SPACs here from a member of the audience here. What are some characteristics when identifying a platform disruptive enough to target or build on, or should you consider building the platform yourself? I think there's an interesting dynamic here, but I think I imagine one of those obviously is super high growth and engagement. But in terms of how you think about what you're looking for, what are the early signals? I wonder if you can share a little bit of that playbook. Not enough to be proprietary, but enough to get excited. So,
no, yeah, I think all businesses, or at least quite a few, start off, third-party platforms. Just find a way to grow off those platforms. Even Google itself grew off, white labeled by Yahoo, and then has become a platform, itself. And so in many cases, companies are just built that way. Now that's essentially just a mode of acquisition, of customer acquisition. So if there's certainly others, there's kind of viral techniques that you've seen, through TikTok or others that haven't necessarily had to have a platform to grow off. So one of the things that I look at is how can a business flourish and acquire customers, because oftentimes there's a lot of great products out there, but they haven't tapped into a mechanism to acquire their customers. And I tend to do more consumer or prosumer businesses than enterprise with big sales.
No, and I think we definitely echo that sentiment, particularly early on around like kind of the growth model, cost of acquisition, LTV, is sustainable, what the channels are, like just to understand that. Otherwise, like it's almost like, the initial seed needs water and fresh light to kind of get to the next level. So, but with that, why don't we, and there's always, I think on the chat window, if you have additional questions or topics, feel free to just chime in there. But I know based on some of we did a light survey before the event, and I think some on the SPAC topic itself, the first question is just around basic learning introduction to SPACs. I think people are reading about it. It's coming all up on the news. It's very exciting. You're hearing brand name companies being taken out via SPAC. You yourself obviously have just raised one, I think a few months back. But wonder if you can just give maybe an initial primer and some of your motivations for going in this direction.
Yeah, so I think that that through kind of Valley history, there's been different mechanisms of platforms that we just spoke about, and those are technology platforms. But occasionally there's financial platforms that emerge, and they often emerge in kind of strange backwaters. And so if you look back at venture capital in the 60s and 70s, it was a kind of strange. It was kind of a strange backwater to leave New York and come out and invest in tech companies. And of course, that's become a very important mechanism to fuel Signal Fire and so on to really fuel the innovation economy. And, I would also argue that Y Combinator at the early stages is another accelerator that has been kind of instrumental in a financial accelerant and program to help build great companies. Similarly, the SPACs, which were given this four-letter name and had a kind of sordid history in the past, have been this mechanism for companies to now get to the public market. So Bill Gurley had often said and critiqued the traditional path to the IPO and had really promoted the direct listing, when in fact we get these kind of surprising developments where it turns out that the SPAC is that new mechanism to get to the public markets. And I was hesitant in this venture of launching a SPAC. We launched it over the summer with my colleagues, my co-founders on this, and we weren't sure if this was going to legitimize. And the speed at which SPACs are legitimizing is astronomical. There's still a lot of riffraff we need to contend with, but that will kind of work out of the system. But SPACs are really becoming a mainstream instrument for companies to get into the public markets.
On that note, do you view it, I think this is also a question that came up, do you view it more as like an exit opportunity or exit option for angel investors with a growing portfolio? Or for yourself, is it also maybe an opportunity to provide liquidity to your current portfolio? Or is it an opportunity to own a significant portion of an emerging company that still has a lot more growth to have?
Well, it's from my perspective, it's been the majority of the innovation economy has gone public early, and then we got into this mode where companies stayed private longer and longer, 12, 13, 14 years. And now we see that swinging the other way. It's a kind of pendulum shift of swinging back towards going public earlier. And the SPAC is the perfect vehicle to take that company public. And investors, venture firms are looking for liquidity. LPs in those firms are looking for liquidity. I'm always reticent to use the term exit strategy because it implies that that's the end, as Eugen, but it's really just the beginning of a lot of these companies. If you look at Amazon, the vast majority, Amazon went public at a $500 million valuation. Microsoft went public at a $500 million valuation, and these companies are in the trillions now. So the majority of their value accrued was done in the public markets, and companies are realizing that and getting out into the public markets, into the light where they can compete, where they can really get insights from analysts and other investors, and it's a win-win for the public markets and for these companies.
Oh, so maybe you view it then as whether it's in your portfolio or maybe another company, it's an opportunity to participate in the upside post-public, right? By having this vehicle because to your point, you're right. The number of $100 billion companies, even a few years ago, was minuscule, but now it's becoming more and more commonplace. And the IPO market itself, if you've kind of been watching it all, the public side, it's been kind of wild and crazy, but the huge pops, huge valuation increases. But is that how you're viewing it then? A way to, you have the early stage exposure through the angel investment, but then the SPAC offers you the way to get exposure or to higher upside for those companies that have great foundations.
Yeah, it's a great point. And our goal of what we're trying to do at A-Star, our SPAC parent company is called A-Star. It's a call out to a 1960s search algorithm, the fastest optimal path to the truth. And our first SPAC is called One, but we're really looking not to flip our shares, but to stay in and be long-term holders of that and find those enduring businesses that are at that next stage.
Got it. No, I think that's helpful advice or context for some of the folks. Many folks on the call are writing, maybe 25, 50, 100K checks. And it's probably a good way to get started, build reputation, get some, build a track record. But down the line, there's ways to kind of go up the market and kind of expand as well. So, And then, I think the other question people have, and this is more almost like a journalist question, I apologize, but, there's been a rush of these things. Hedge fund managers are doing one. Virgin Galactic, I think, you kind of keep reading about them. Do you worry at all? Is this a fad? Is this a one-time thing? Is there sustainability? What kind of gives you conviction that this is maybe a new financial product and opportunity for a lot of these later stage companies and also later stage investors?
Well, we've just seen. I think there was a lot of uncertainty even a year ago, and we've just seen a lot of legitimization happening with some really wonderful fund managers, with some wonderful operators entering the space. So it appears to be moving on from this notion of a fad stage. It also really is. I think all kind of new phenomenons start in a way where they're overhyped or seen as a fad, and they have to prove themselves over time. There'll be some bumps and ups and downs in the SPAC world, just as you see in the IPO world, but it's without a doubt a lasting phenomenon at this point.
Yeah, no, I think you remind me of I remember her name, Carly. There's a theory of kind of capital financial cycles, and you always start with a kind of a huge spike, overinvestment. And then there's a big jump, kind of dip out, and then a recovery, right? And so there's very much a macro perspective, correct, and we're probably past that first kind of anchor going forward. And then maybe another question I also have is around when you think about, I think you raised, correct me if I'm wrong, 200 million or 400 million for the initial vehicle.
We raised 200 million, and the idea there, Eugen, was to really focus on believe it or not, smaller businesses around $1 billion. You generally look at companies that are kind of 4 to 6 times in size, or you can lever that up with a PIPE, which is an additional means of capital raised. But we chose that smaller size as all the SPACs were going larger and larger, because we think that earlier stage growth companies should be public. You could have 50 million in revenue and be growing triple digits, and we think that should be a public company.
Yeah, no, I think it's a great point, because the last several years, and probably for folks in the audience as well, if you've participated in this, there's been so many new seed companies. There's just been, we see this with our data, just an explosion of both seed, Series A, Series B, right? But at the end of the day, though, only a portion of those can make it to the next level. And there's probably good quality companies out there that maybe just don't have access to capital, or they're just maybe kind of in a plateauing stage. Whereas, what you're providing is a wonderful option to kind of exit, get some liquidity, but then also get operational expertise to scale up and continue to grow. And they're kind of just hidden within the ether a little bit. So, yeah.
That's correct. In those companies, a lot of times are just really excited at the process, where you can project forward financials, where you can reveal a lot more information than in a traditional IPO, where the S1 has to be very restricted. So in the process of a SPAC, you can reveal a lot more information. You can move a lot faster, and that's really attractive for companies.
No, I think that's a great point. And there's a wealth of opportunity that's given kind of the growth and the kind of scaling of all these mid-stage companies per se. We've got some good questions for the audience. Actually, I'll just start down the line here. Taylor Berida, actually one of our venture partners and former head of corporate development at Adobe, he was asking, any thoughts on SPAC offs, where multiple SPACs are pitching companies, competitive situations, valuation creep? I wonder if you've encountered this or anticipating issues here around the rise of these vehicles and kind of that inherent conflict.
Yeah, great question. Now, these, there is competition in the market, but we just don't look at that. We're looking at the individual company. It's much like a financing round. We're just trying to develop a relationship and seeing if there's good chemistry. If there's not, then they should go with another SPAC. So we're really not paying as much attention to competition as we are finding a great company and building a relationship and getting to know them. And that's been really a rewarding process. So we're trying not to think of things as kind of a zero-sum game or some kind of highly competitive process. The other side is there is just a fair amount of proprietary deal flow that, there's just personal relationships and known multi-year relationships. And then finally, not all companies really want to work with kind of financial engineers. They want to work with operators, and we see eye to eye in that manner. Now, I think there was a second part to the question.
Yeah, I think. There's another question related to that, just around are you worrying about people taking advantage of retail investors through SPACs, folks who may not be? I mean, that's probably more on the investing side, the public side. Any concerns there, or do you have a good handle on who's actually buying into the SPAC when they go public?
It's the retail side is really concerning to me. This is the Robinhood army that's really, has been emboldened by this incredible bull market that we have. And, I think that it's certainly driven a lot of the gains. You're not in a lot of the companies that are out trading right now. You're not seeing as many fundamental investors, and we need more fundamental investors and less retail investors. And the reason I don't want to sound like I'm elitist against retail investors, it's just there's such a danger of losing a lot of money. And, that money is college money, that money is mortgage money. And at some point, we'll see a correction in the market, and we just don't want that to affect the retail investor.
No, that's a great point. I think you remind me of there's Eric Ries. He started, I think, an alternative stock exchange where it incentivizes long-term holding.
Yeah,
LTSE, exactly. And I think, and then you've heard a lot of kind of funny anecdotes. I don't know if this is based on fact or not, but a lot of folks who used to gamble or kind of bet on other markets or games or what have you have moved to Robinhood. And that's causing a wild fluctuations and kind of irrational behaviors throughout the market. And so you guys are obviously, going to experience some of that. So excellent. No, I appreciate you sharing that note around on the outside, the SPAC element can seem a little bit hypey. It can seem like a lot of flood of capital, what have you. But I think the way you portrayed it is that you're looking for specific kind of target opportunities. You're not looking to outcompete or get into a valuation war or anything like that, because you're right. It is very much, if you find the right partnership, it's not right just paying a check and getting out. It's very much around preparing that company for the next stage of growth and going away from the term exit, much more around next phase, realizing that there's a huge mountain of opportunity if you do it right for these companies after they've achieved product market fit, after they maybe have a team of about 100 or 200 people. There's a lot more way to go. So.
The best companies are really, that's a great point. The best companies are really aware of not overvaluing their company. Now, they're the wonderful thing of the SPAC is that it's a set your own price. And so you have a much better pricing accuracy. Now, you still have some big leaps in the market, but that price is at least much more set by the founder and CEO and in the board of those companies, and that gives a better accurate reflection of the true price out there, and we think that's very important in this.
Yeah, no, absolutely, because I think you're not looking to just sell to a financial buyer. You're going to be working with them. This is a long-term game, and so being honest and upfront and kind of sharing concerns is going to be good for both parties. I know we're at the hour.